Imagine getting paid just for owning stocks. Sounds pretty good, right? That's dividend investing in a nutshell. It's all about earning passive income from the stocks you already own. For beginners, it's a fantastic way to build wealth and generate income over time. In this video, we're breaking down the basics of dividend investing and giving you a simple plan to get started. Dividend investing is simply investing in companies that share their profits with their shareholders. These payments are called dividends. Think of it like owning a small piece of a company and receiving a share of its earnings. It's like being a part owner who gets a cut of the profits. These dividend payments are typically made quarterly, but some companies pay monthly or even annually. It varies. Unlike capital gains, where you profit from selling a stock at a higher price, dividend investing focuses on generating income from the stocks you hold. It's about the cash flow. Dividend investing provides a consistent income stream. You get regular payments just for holding the stock. Even better, you can reinvest those dividends to buy more shares, leading to compounding returns over time. It's like your money making more money. Dividend stocks can also reduce volatility in your portfolio. You're earning money even if the stock price dips a bit. This strategy is ideal for long-term investors. It's perfect for those seeking passive income and building wealth steadily. It's especially appealing to retirees who need a reliable income stream to cover their expenses. Dividends can provide that stability. But it's also suitable for younger investors who want to build wealth over time through the power of compounding. Start early, and the results can be amazing. The beauty of dividend investing is that it's a tailorable strategy. It can fit various financial goals and risk tolerance levels. Let's cover some key terms you'll need to know. First up, dividend. A dividend is simply the payment you receive per share of stock you own. It's the cash you get. Next, let's talk about dividend yield. This is a crucial metric. Dividend yield is the annual dividend payment divided by the current stock price expressed as a percentage. It tells you how much income you're getting relative to the stock's price. It's useful for comparing the income potential of different stocks. A higher yield means more income per dollar invested. But be careful. A higher yield doesn't always mean it's a better investment. Sometimes a very high yield can be a red flag. Now let's discuss the ex-dividend date. This is a crucial date for dividend eligibility. If you buy the stock before the ex-dividend date, you're entitled to receive the next dividend payment. You're in the club. But if you buy the stock on or after the ex-dividend date, you won't receive the upcoming dividend. You'll have to wait for the next one. What about dividend aristocrats? Sounds fancy, right? Dividend aristocrats are companies that have increased their dividend payments for 25 plus consecutive years. That's a long track record. They're often considered reliable dividend payers. These companies are committed to rewarding their shareholders. Finally, let's talk about the payout ratio. This is another important metric to understand. The payout ratio is the percentage of a company's earnings that it pays out as dividends. It shows how much of their profit they're sharing. A lower payout ratio suggests that the company has room for future dividend growth. They're not paying out everything they earn. Ready to start dividend investing? Here's a simple 4-step plan to get you going. Step 1. Open a brokerage account. You'll need an account to buy and sell stocks. Choose a reputable online brokerage that offers commission-free trading. This will save you money on every trade. Some popular examples include Fidelity, Charles Schwab, and Vanguard. Do your research and pick one that fits your needs. Step 2. Research dividend stocks. This is where the fun begins. Use online resources like Yahoo Finance, Google Finance, and other financial websites to find potential dividend stocks. There's a ton of information out there. Analyze the dividend yield, payout ratio, and dividend history of each stock. Look for companies with a solid track record. Consider investing in stable industries with consistent dividend payments. Think utilities, consumer staples, and healthcare. Step 3. Build a diversified portfolio. Don't put all your eggs in one basket. Invest in a variety of dividend-paying stocks across different sectors. This will reduce your risk. Start with well-established companies that have a history of paying dividends. These are often safer bets. Remember, diversification is key to managing risk. Spread your investments around. Step 4. Reinvest your dividends. This is where the magic of compounding happens. Set up automatic reinvestment to buy more shares with your dividend payments. This is also known as DRIP, Dividend Reinvestment Plan. Over time, this compounding growth can significantly increase your wealth. It's like a snowball rolling downhill. Let's talk about some common mistakes to avoid when you're starting out. First, chasing high yields. It's tempting, but it can be dangerous. Avoid solely focusing on the highest dividend yields. A very high yield can sometimes indicate that a company is struggling. Do your research and make sure the company is financially healthy before investing. Don't just chase the yield. Second, ignoring company fundamentals. Don't just look at the dividend payment. Analyze the company's financial statements, debt levels, and growth prospects. Understand the business you're investing in. A strong company is more likely to continue paying dividends in the future. Look beyond the dividend itself. Third, not diversifying. This is a big one. Putting all your money into a single stock is risky. If that company runs into trouble, you could lose a lot of money. Diversification is key to managing risk. Spread your investments across multiple companies and sectors. Fourth, trading too often. Dividend investing is a long-term strategy. Avoid frequent buying and selling based on short-term market fluctuations. This can eat into your profits with transaction costs and taxes. Be patient and let your investments grow over time. It's a marathon, not a sprint. Dividend investing is a powerful tool for building wealth and generating passive income. It's a great way to make your money work for you. Remember to do your research, invest wisely, and be patient. It takes time to build a substantial dividend portfolio. It's a marathon, not a sprint. Stay focused on your long-term goals. So, are you ready to start earning passive income from stocks? It's easier than you think. What are some of your favorite dividend stocks? Or what questions do you have about dividend investing? Let us know in the comments below. If you found this video helpful, please give it a like and subscribe to our channel for more investing tips. We appreciate your support. Thank you for watching. We hope you learned something new today. Happy investing!